The question is, will supply unlock and will there be more deal flow to finance?
How do you analyze the impact of post-liberation debt tariff and policy uncertainty on private debt?
I think it's important to consider that private debt has always existed during periods of volatility, and usually the best value is created when you're investing through those periods. So more recently, we do have Liberation Day, we have tariff and trade uncertainty, we have general policy uncertainty, and one of the key value propositions of private debt is to provide liquidity to the market through periods of uncertainty. So in our view, it's an opportunity. The question is, will supply unlock and will there be more deal flow to finance? Generally, that's going to depend on some level of clarity in policy and capital markets before that happens.
And what can be said about the development of the retail investor base on private credit?
It's developing rapidly. I think for structural reasons, retail having access to private credit and privates generally should exist and are positive. I think the traditional 60-40 model of only invested in fixed income and equities is in many ways no longer sufficient for the average investor. It's already the case with institutions, so it stands to reason it can also be the case for retail investors. The trick, of course, is understanding the underlying assets, and fundamentally they are illiquid. So how do you protect structure and put wrappers on the product so that retail investors can participate in a way that's productive and that they understand the risks associated? I think if you can do that, and there's already been market developments to do that, for certain types of retail investors that understand the illiquidity profile, the return opportunity and the dividend opportunity can be very attractive.